Morning, everybody, and welcome to the Local Pension Committee meeting. I shall start the meeting off with the appointment of chairman. At the annual meeting of the County Council held on 17th of May 2023, Mr. Barclay was nominated as chairman-elect to the Local Pension Committee. Can I have a proposer and seconder that Mr. Barclay be nominated chairman?
Can I propose?
Propose. Thank you. Thank you, Mr. Barclay. You are appointed chairman of the Local Pension Committee for the 23-24 year. So I'll hand over to you for the rest of the meeting.
Thank you, Angie. So, good morning. Welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. For those not able to watch live, the webcast will be recorded and made available for viewing on the County Council website after the meeting. Before we begin, can I just remind everyone to turn on their microphones when you wish or are invited to speak, and also to turn them off afterwards. And I'm probably the most guilty party on that, so bit of hypocrisy to start the meeting. I've received apologies today from Mr. King and Mr. Bill. I welcome Mr. Harrison, who is present for Mr. King. Also online, we have Fiona McMillan, Head of Law and Deputy Monitoring Officer, who has joined us today. We now move on to the election of the Deputy Chair. I propose that we nominate Mr. Grimley. Could I have a second? Thank you. So, Mr. Grimley, you are elected as Deputy Chair. The minutes of the meeting held on the 3rd of March 2023. I propose that the minutes of the meeting held on the 3rd of March 2023 are taken as read, confirmed, agreed. Is this agreed, everybody? Yep, thank you. We now move on to item 4, which is question time. I've received no questions. Agenda item 5, questions asked by members under Standing Orders 7.3 and 7.5. We've received no questions. To item 6, to advise any other items which the chair has decided to take as urgent elsewhere on the agenda. I have not been notified of any urgent items. The next item is declarations of interest in respect of items on the agenda. Does any member have any interest they wish to declare? No? Okay, that's fine. Thank you. So the next item is the item 8, Stafford Capital Partners Timberland update, which is on pages 19 to 52 of the agenda. I believe we have Stephen Adicott and Mr. Gazette and Mr. Dermot McCluskey with us to present. No, they're not here yet.
Outside.
Oh, they're outside. No, he's just. Good morning, and thanks for coming along this morning. We're just Bulesh is going to do, which has now disappeared. Oh no, he hasn't. There he is. Bulesh, you're just going to do a short introduction before Timberland take over.
Sure. Just a bit of context then. It's worth running through the background the fund has an infrastructure allocation to Stafford. It's within the income asset group element of the portfolio. We've got 7 managers within that section already for infrastructure. The fund's Timberland investments are managed by Stafford, who manage over 8 billion in assets across timberland, agriculture, infrastructure, private equity and private credit asset classes. Quick reminder, the allocation for infrastructure is 12.5% of total fund assets. That was up from 9.75 at the January 2023 meeting. There's a paper elsewhere on the agenda that summarises the changes that were approved. As at the 31st of March, the fund is underweight to infrastructure, about 2.6% of total fund assets. However, 100 million was approved in April, yet to be called. We've got 3 investments with Stafford already in older vintages, totaling about 130 million, about 2% and a bit of total fund assets. These are closed-ended and should return money back to the fund at the scheduled end dates of the investment. At the July 2022, so about a year ago now, the investment subcommittee committed £55 million to a new Stafford Capital Carbon Offset Opportunities Fund. Our colleagues will talk about that in a moment, so I won't talk too much about that. No money has yet been called for that fund. On to page 20, points 7 to 10 refer to our current investments. So these are SIT 6, 7 and 8 old vintages, all closed-ended, like I referred to, invests in large global timber funds, which obviously own timber farms that grow sustainable lumber for sale. The holdings are long-term and have shown in the past to have lower correlations to equities and bonds. Studies have shown that 65 to 75% of that total return is generated from biological growth, which is independent of economic cycles. Just thinking back to March 2020, when kind of world stopped, trees kept growing. So, just points out the diversification part. 11 to 14 talk about the Carbon Offset Opportunities Fund. Just point 11 on this section. It's just been launched. We committed 55 million to it last year. At the time of writing, just 2 other LGPS funds have also committed to this fund. The total commitment across all 3 of those LGPS funds is about £200 million. On to point 15, summarises what the Stafford presentation should cover. So you've got A to G there. I'll leave you to have a read, but I've got nothing more to say other than to hand over.
Thank you, Will. So welcome to Stephen, Marek and Dermot this morning. So please, thanks for coming along, and please carry on with your presentation.
Perfect. Hopefully you can all hear me. Well, firstly, thank you very much for inviting us here today. It's a real pleasure to be in front of the Leicestershire County Council Pension Scheme again, our pension committee again. I think, Kat, is that your driving, Kat? Sorry, thank you very much. It is just pulling up our presentation for today, but I can maybe just quickly touch on a few introductions from our side. So as mentioned, I'm Dermot McCluskey. I am the head of the client team in Stafford in the UK, and I am joined by my colleagues Stephen Adicott on the far end, who co-manages the Stafford's Timberland business, and Marek Gizo, who's a principal within our Timberland business and is responsible for the implementation of Stafford's latest fund, the Stafford Carbon Offset Opportunity Fund, as Burlesh just mentioned. Both Steve and Marek are professional foresters, so I'll certainly hand over to them for the detail of the presentation. But I can quickly just talk you through the agenda that is on the screen here in front of us. So we will begin with a quick introduction to Stafford Capital Partners and an update on our Timberland business. We will then move into an update on your Timberland portfolio with us, so through investments in SIT 6, 7 and 8, as Burlesh highlighted just before moving on to a update of the investment opportunities that are in front of us for the new Carbon Offset Opportunity Fund. We will then touch as a final point on the emissions intensity profile that an investment in timberland can offer. So moving slightly beyond the pure financial proposition of investing in the timberland sector and some of the other benefits that an investment in this sector can have, and its support as part of the net zero transition. If that's okay, we can maybe move on to the next slide, but I should add, please do feel free to interject and ask questions at any point. We'd love to ask any questions you might have.
Thanks, Dermot. We've got the slides as well on our laptop,
Perfect.
Which is great.
Perfect. So just to quickly touch on who we are as a business. We are an independently owned firm headquartered in London. We manage 8.1 billion in assets across the sectors of timberland and agriculture, infrastructure, and also sustainable private equity and private credit. As a business, I suppose there are two things that we're really known for. The first of those is that we pioneered the use of secondaries from our foundation in the early 2000s in alternative asset classes. And really feel that that's a great way to access those sectors and gain superior risk-adjusted returns. The second is that we fundamentally believe that protection of the environment, of human rights, and strong governance enhance and underpin financial performance. And so with that, we have been signatories to UNPRI since 2010. The operations of our business are net zero and have been for some time. And as a group, we've committed, like Leicestershire, to achieve net zero across our portfolio by 2050 or sooner. So very much aligned in terms of our aspiration. The final points I would maybe point to are simply that we are a global team. So we now have 86 people in our business, spread across 9 offices globally, really with a desire to be obviously close to and in the markets where we invest. I think I'll stop there and maybe pass over to Stephen Adicott, who can give you an update on our timberland business specifically. Thank you.
Just make sure that's on. Thanks, David. So we have a team of 17 timberland. Sorry, I'm a bit croaky this morning. We have a team of 17 timberland professionals, or 18 if you include our Chief Investment Officer. This team's supported by, within Stafford, we have our own team helping us to source secondaries across all of our alternative classes. We have a tax structuring team. We have an ESG team within the group. We also have a data analytics team for the intent purpose. I mean, we sit in the timberland sector is about 100 billion of institutional capital. We have 3 of that. So we're a significant player, but we also sit across, thank you, I appreciate that. We also sit across all the timberland managers. So in essence, we're at the forefront of knowledge of what's happening in data. And so having that specific data group helps us with that sort of analysis of not just financial returns, but ESG performance and other aspects of the timberland sector. We're looking to expand this team with a further 4 staff to come in over the next 6 months. And that will particularly be transaction staff. We have an ESG team across the whole company, but we're looking for an ESG dedicated timberland professional as well. And then another portfolio manager. So hopefully it will keep expanding as we expand within the sector. Just moving on to slide 5, thank you. So the 2 main strategies that, the 2 main strategies that we invest via are our international timberland funds. That's what we've done over the past 20 years, and they are into brownfield assets. So that's existing timberland assets that where we harvest the timber for a commercial cash yield of around 4 to 5%. And then we sell those timberland assets at the end of the life of the fund in what is an open auction market, where we usually realise asset appreciation of an additional 4 to 5%. It's an Article 9 fund, according to the SFDR. Its return components are just that: timber harvesting, asset appreciation. And because we buy via secondaries, we can usually buy at discounts to the underlying valuations. Geographies, we focus predominantly in the United States, Australia and New Zealand. All up, they represent 90% of the portfolios, but we do also have investments into fast-growing plantations in Latin America, particularly Brazil, Chile and Uruguay. Those fast-growing plantations have been established on ex-farmland. In comparison, we've recently raised the Carbon Fund, and we greatly appreciate the support provided by Leicestershire in the Carbon Fund. The Carbon Fund is looking at greenfield assets, mostly new plantation development, but also some natural forest restoration. The reason the Carbon Fund is an Article 9 fund is to claim carbon credits, you have to do something new. We can't just buy an existing timberland asset and claim carbon credits from it because it's not doing anything different to what it's always done. That carbon's always been stored and we've always harvested what's grown. So to establish new plantations, which is needed for the timber production, but also to do that for sequestration purposes, and at the same time creating new natural forest, that's what we're looking for. It is a different risk profile in the sense that greenfield planting means that you don't get the cash returns from timber harvesting for at least 10 years. And so it's a longer wait and lead time before that comes back. But what it does create is, sorry, yes.
Greenfield plantations take greenfields away from agriculture, food production. Are you happy with that?
It's a different type of food production. So what we're focusing on is low-grade cattle country, basically country that was cleared 30 to 40, sometimes 70 years ago, but it's been left with very low intensive management. I was recently in Brazil, for example, and the sort of country that we're looking at where this unfortunately was rainforest maybe 60 years ago. The cattle, about 10% of that land is in intensive agriculture for cattle production. 90% is basically cattle, where the cattle's just there to keep eating small bits of regen and to keep the land optionality available for the owner. So it's not really an intensive food production. So we're not investing in high-grade quality farmland in Australia, New Zealand, or within the UK, for example. What we are doing is looking to re-establish forests in areas that have always been forests. Yeah.
Thank you, Louise. That's a good point. Thanks.
And so it's an Article 9 fund. There will be returns from the carbon offsets coming back to investors at around year 5. In saying that, though, investors have the option of holding those offsets themselves and using it to offset their own emissions, or they can hold the offsets and then sell them at a later date when the price, which we expect, will increase over time. Again, it's in the same geographies where we are. Marek will be going through some of our investment opportunities. Basically, we're looking to leverage our global portfolio where we have contacts, we have knowledge of the asset class, we have markets, and just building on those estates. Thank you. I'll just move on now into your exact portfolio that you've invested with us over the past around 13 years, I think it started. And that's into our 6th, 7th and 8th timberland funds. Those timberland funds are into brownfield investments where they've always been existing forest harvested for timber production. And looking firstly at the table on the left, excluding the recent Carbon Fund commitment, Leicester's total portfolio is £129.5 million. This is fully drawn, and the portfolio has a NAV of a bit under that at around £127 million. Over the past 10 years, £79 million has been provided back to Leicestershire, to the pension fund, and that results in a distribution multiple of 0.61 and a total value of relative to paid in of 1.59. The investment return to date has been 7.5%. Our target return is 8%. But we typically see a premiums paid on the exit of these assets when they come to market. They are valued by independent consultants, and usually those valuations are around 20% below what the market actually pays for these assets when they come on the market. So we're pretty comfortable that we're on target, but we have had a particularly strong 2 years in the past 2 years, which is kind of nice because one of the investment thesis is it performs well as an inflation hedge, and it's counter-cyclical. So even with other markets going down, we've seen really strong performance. Part of the reason for that as well was that we have less than 13% debt within the portfolio. So it's not an indebted portfolio. And that debt is at the underlying asset level with zero debt at the Stafford level. Looking at the waterfall chart on the right as to what's happened over the past 12 months, what we see is from left to right. Again, the NAV starting at 137 million. A small amount of capital was called for the very final investment for SIT 8. A total of 28 million of distributions, which is effectively a 9.5% distribution, but that is a mix of, that's a 20% return of value. That is a mix of capital returns, so from asset sales and from timber harvesting. Mostly asset sales. Those asset sales have actually sold at premiums of 30% to the underlying net asset value over that time, over the 12 months. We've also had asset appreciation of 9.5%. Why those assets have appreciated at that level? It's a combination of things in the sense that log prices have generally gone up, although they have flattened out this year. That increases the value. But we're also seeing significant number of new players coming into the marketplace, looking to invest into and to gain the ESG credentials that timberland provides. So that has led to those premiums being paid on assets, which eventually has led to some valuation gains as well. And then we had some FX gains. So the USD has depreciated against the pound. Has appreciated against the pound. And given we have quite a lot of US assets, and even the assets in some of the Latin American countries and logs in New Zealand are traded in USD assets. So that also helps the USD returns. Outside of that, we've ended up with a NAV at the moment of 127 million. Just moving on to the next slide, thank you, onto slide 8. As a quick overview of the portfolio, and I just draw your attention to the pie chart in the middle, where your portfolio is 50% in the US, 24% located in Australia, 16% in New Zealand. You might ask why New Zealand? New Zealand's actually the world's largest log exporter, and it's because it grows fast, trees fast. It also has a lot of forest located close to ports. And Asia is the world's largest net importer of logs. It basically can't be self-sufficient. And so New Zealand is a country that's benefited from that. When we look, and finally, the last 10% is across Brazil, Chile, and Uruguay in those fast-growing eucalypt and pine plantations. The total portfolio sequesters 770,000 tonnes per year. But I would just say that that's not net. We have to net off the harvesting. And when we harvest timber, we're effectively, when we account for that, we effectively have to assume it's burnt, even though a lot of the timber is actually stored in furniture and housing. But we have to sort of say that it's zero. So while we put down the amount that's sequestered every year, unfortunately, we can't claim that as carbon credits. Looking at just very quickly in terms of the outlook of the next year ahead, we're expecting cash yields of around 3 to 4%, modest valuation gains of 3 to 4% rather than the 10 last year. That's on the back of muted housing starts in the US. The housing starts in the US, for example, are at 1.4 relative to a 1.45 long-term average. That's still really good given where the interest rate environment is at, which reflects the latent demand for housing within the US at the moment. But we're just being a bit conservative in what we expect the valuations will do. Also, China and the other big market, the Chinese housing starts has been mute. I would just add that when we look at the look through of the portfolio, around 20% of the returns are from US housing and around 15% from the Chinese real estate market. So while I'm just emphasising those two, they're not necessarily larger than 35% of the drivers of the returns. No, that's sorry, Balesh, that I was just sort of ad-libbing there, but otherwise I'll now hand over to Marek, who's going to talk about the specific pipeline for the carbon opportunity. Thank you.
Thank you, Steve. That's perfect. There we go. So we had a first close for the carbon fund at the end of February this year at $242 million. And what we have been doing then in the last couple of months is really looking to build out the pipeline of investment opportunities so that we can start deploying that capital effectively. We currently have 17 pipeline opportunities around the world that we are assessing, with a total combined value of approximately $700 million. I thought what would be interesting today was maybe just provide a quick snapshot of 3 of those opportunities, simply to provide a bit of a flavour for the types of opportunities that we are looking at. And the first of those 3 is the details are, or some of the details are contained on this slide. It's actually an opportunity in New Zealand. The opportunity was presented to us by a manager in New Zealand that Stafford knows very well and has worked together with for quite a number of years. It's actually it takes the form of a joint venture that was established by a local New Zealand firm that was active in the energy sector, together with this manager. And the way that it was structured, this counterparty coming from the energy sector clearly had a need for carbon offsets, and they were looking to buy bare land in New Zealand, and the manager's contribution to the joint venture would then be to fund the costs of planting that land and maintaining the tree crop through till it reaches maturity. At that point, about 80% of the wood volume would go to the manager, 20% would go to the JV partner, the energy firm, and 100% of the carbon offsets that were these tree crops would be eligible for would go to the joint venture partner. That partner now has seen some change in its own strategy and has concluded that they don't need the volume of carbon offsets that they originally expected, and so they're looking to exit that joint venture arrangement.
And can I just add, I think they're more looking to exit because that's the story they give us, but there's a bit of desperation.
Yeah. So we have an opportunity here to acquire their interests in the joint venture effectively at cost. They already have 3 properties. It's 1,400 hectares of plantable land. Half of that, around 700 hectares, has already been planted. If one looks at in New Zealand, they're typically planting about 1,000 trees per hectare when they're establishing new plantations, which means there's already 700,000 trees in the ground within the scope of this JV. So for us, the original target of the JV was to reach a total of 10,000 hectares over a 5 to 8 year period. So there's a framework here that we can use to build out the existing land holdings and add some additional properties into the JV over coming years. So for us, this is a very nice sort of starting point, a framework, if you like, that gets us a foot in the door in which we can expand on over the next few years.
I should just add that type of land that we're buying in this case is typically low-grade sheep country that's on quite steep hills, so erosion-prone areas where the reforestation of these areas will actually assist the landscape.
If we move to the next slide, the second opportunity is one that's in Australia.
Dan.
Thank you, Mr. Chairman. I'm interested to know the percentages between soft and hardwood and those future markets. Obviously, wood burning's been a very popular thing, but now it's being monitored much more closely. And so that would make more hardwood, kiln-dried woods necessary for that type of operation proceed. But it's interesting to know the balance. How does it work in ratio? Thank you.
Thank you. To some extent, that's dictated by country or region that you're investing into. New Zealand, for example, it's almost 100% softwood, given that commercial hardwood, there's few hardwood species that grow well in the New Zealand climate. The hardwoods that we would be anticipating within the Carbon Fund are more likely to be located in Latin America rather than in Australia or in New Zealand. On balance, we would be thinking about 70% of the fund would be investing into softwoods and about 30% into hardwoods. And the majority of that hardwood would be eucalyptus, so not necessarily hardwoods that would be going into the furniture type market.
Thank you. Thanks, Tom.
So the second opportunity is in Australia. This is, again, a partnership, this time with an industrial wood processor in the country. They're a large sawmiller. They operate 6 sawmills across the country. They buy the majority of their softwood logs from the open market, and they do have a small area. It's about 13,000 hectares in total that they manage themselves. They own that, they manage it. It's a bit of a buffer for them against fluctuations in prices for logs in the open market. They are looking to build out their own supply and to sort of decrease their reliance or exposure on sourcing wood in that open market. And it means there's an opportunity here to sort of work alongside with them, where our fund would acquire the land, again, similar to the joint venture structure that we spoke about in New Zealand. They would contribute the costs of planting and maintaining the trees on that land. They also have a track record in successfully developing carbon projects in Australia, which brings another skill set which would be highly relevant for us in the case of this opportunity. This is clearly an off-market type of opportunity. It's one that we have a lot of flexibility to structure the deal according to in a way that sort of works best for the objectives of our fund.
I should just add that the future end markets for the New Zealand opportunity is to service both domestic markets in New Zealand, but also that export demand in Asia, that deficit in Asia. With the Australian forest, Australia is a net importer of lumber. It doesn't have self-sufficiency. And so we see an opportunity here to create further forests within Australia to meet that growing demand for domestic timber. Steve.
And sorry, Mark, is it worth just checking for time? We have sort of one more case study on a transaction that we're working on, as well as 2 slides on the emissions intensity side. So just wanted to check.
That's absolutely fine. Perfect. Thank you.
Thank you.
Thanks, Dermot. So if we move then to the next slide, the third opportunity is one located in Paraguay. Well, Paraguay is a country that sits adjacent to Brazil and Uruguay. It's not one that many people know too much about, but it's actually a country that's larger than Germany in terms of its total land area. Yet the population is only 7 million people. 3 million of whom live in the capital city of Asuncion. So there is very good availability of land. There's very little competition for that land. Most of it is used for extensive or low intensity cattle raising, like Stephen described earlier. So there's an opportunity for us to acquire good quality land for forestry at quite reasonable prices. It is a country that is starting to feature more on the radar for forest or timberland investors. We see about 5 different groups that we're aware of today already starting to make an entry into the country. We've been out there, we've had a look on the ground. It's encouraging what we see. And again, there's an opportunity here for us to structure an investment that we can determine scale, location, and type of operations to be established on that land base. So again, quite some high degree of control on what that investment could look like.
Just very quickly, when a property is purchased, about 70% of the land is used for commercial plantation development. There might be about 10% of remnant vegetation or rocky outcrops, but the other 20% is where we'll be looking to do natural forest restoration. And that's usually along the gullies, along the creeks and the watercourses. So we create those permanent corridors of wildlife habitats and sort of connecting the remnant vegetation across the landscape.
Thank you. Thank you. If we move then to slide 14, just covering the emissions intensity. What we are showing on the chart on the left-hand side is really a sort of a visual breakdown of what does the various components when thinking about emissions intensity for the carbon fund look like. It's showing data for what the results would be per $1 million committed or invested into that fund. Starting from the left, the dark blue bar below the line, that's the total amount of CO2 that is sequestered by the tree growth each year. The next bar, the 100 figure to the right, that is the actual emissions that are associated with the management of that forest. So it's the preparation of the site, planting the trees, logging some of the wood volume and transporting logs to the market. It's quite a small number. That's very typical. Normally you're looking at around 2 to 4% of the total sequestered volume is emitted by those operational activities. Then what Steve described earlier as well, or touched on, that green bar, that is carbon contained in the wood that is removed from the forest after being harvested. Now, this bar is really looking at through the lens of just scope 1 and 2 emissions, because there's a substantial, about 60% of the carbon contained in these logs goes into long-lived wood products, so lumber, sort of wood-based panels like MDF or particle board. And that means carbon in those products is stored, in the case of lumber as an example, for a half-life of 35 years. So you're looking for, decades-long storage of carbon in that product. That benefit's not captured or reflected in our numbers here. And then the yellow bar, that is the carbon equivalent in the offsets that are sold by the fund. Obviously, if one is selling those offsets, you're relinquishing the right to claiming the climate benefit associated with them. And that leaves us with a residual value of a negative number of around minus 600 tons of CO2 equivalent per year per $1 million invested. What does that mean? The example there on the right is just looking at that as far as emissions intensity goes. Most of the benchmark indexes, which are shown there in the blue bars, see positive numbers ranging from about 100 to 300 tons of CO2 per $1 million of sales, whereas the carbon fund would be substantially negative by comparison. So that we see as an opportunity to make a significant positive impact to the emissions profile of a portfolio. The next and last slide really just looks, so just covering a few points around the voluntary carbon market. Now, carbon would be generating approximately half of the overall return from the carbon fund. The other half is coming from traditional timberland sources like wood sales and appreciating asset values. So it's useful just to understand, what type of risk or uncertainty is associated with the voluntary carbon market. And we could lump those into two broad categories in this instance. The first concerns related to the quality of carbon offsets, and the second around how can we actually use offsets in a way that wouldn't attract negative criticism. On the quality side, there has been a fair amount of applications about questioning the quality of credits coming or offsets coming from certain types of projects. However, I would note that most of that is directed towards REDD+ carbon projects, so projects associated with protecting natural tropical forests. And this is not a type of carbon project type that our fund is intending to invest into. So it's important to know that we have no exposure to REDD+ type projects within the scope of our own fund. On the usage side, clearly there's also been a lot of back and forth in the media about greenwashing. Are offsets simply a license to pollute? And again, within the market, there's quite a few there's sort of movements here on several fronts in terms of how to address that concern. Importantly, the Voluntary Carbon Markets Integrity Initiative, it's quite a mouthful, is releasing a code of practice later this month that will be concerned with what kind of claims can one make around the use of offsets that will be deemed, reasonable and responsible claims. That's an initiative which is also supported by the UK government, so something that should be seen with some weight here. And then last point, there was an interesting piece of research published by a UK group called Trove Research that concluded that groups that were making use of carbon offsets were not actually using those offsets and doing nothing to address the emissions from the rest of their activities, but were actually reducing those at double the rate to those that were not making any use of offsets. So that was an interesting paper, one which kind of rebuffs that view that making use of offsets is simply by companies is simply being used as a tool to avoid having to do anything about the emissions from the rest of their activities. So I'll stop there and
okay. Thank you very much, Dan.
How do you measure the consequences of shipping, which is a major footprint, reference carbon? How does that, because it's very interesting listening to the understanding, the basics, the principles of how you built a business, if you like, that creates a product but creates finance and everything else. But there's a consequence somewhere, because obviously these huge ships and it's all being moved around the world, this timber. So you get a great number at one end and say, great, look, we've really achieved something wonderful here for the world. And then suddenly, how does it catch up? Or is it always separated and never the two shall come together as a consequence? Thank you.
Yes. So the previous slide, the operation.
Yeah, so if you could perhaps just switch back to slide 14, where we had that waterfall chart. So it's a good question. And like I just said, what we're considering here is just the scope 1 and 2 emissions. So in other words, that's emissions within our own organizational boundary, so to speak. And in the case of logs from New Zealand that are being exported to China, our organizational boundary stops at the wharf gate, so at the entrance to the port. So the emissions associated with shipping that log to China would be part of the Scope 3 emissions, which we're also working towards measuring, but it is more complex because there's a lot more components to that. Having said that, the emissions per cubic meter or ton of logs for that journey is really quite low. If I use transport costs as a proxy there, the cost to ship a log from New Zealand all the way to China is the same as putting that log on a truck in the US South and driving it for about 140 kilometers. So and if you think fuel costs, obviously the major part of that, the shipping is a far more efficient way to move a bulk product like logs around. But the answer to your question is that would be accounted for in the Scope 3 emissions, and that's something that we're it's still a work in progress as far as accounting for the carbon in our across the whole life cycle of our products would look.
I mean, as an estimate, we'd expect it to be less than 10%. Sorry. As an estimate, we'd expect it to be less than 10% of the total sequestered carbon in terms of the volumes associated with those emissions of the transport.
So basically, it's work in progress then, because you're establishing something that looks absolutely fantastic from a distance, but obviously, like so many other things in the world, there's always a consequence. And we obviously understand that huge vessels going across the oceans pollute the oceans and all sorts of consequences to it. And it's trying to get a picture of it, because I'm supportive. I understand where you're going, but one man's image of glory is, and another man's, somebody's got to pick the cost up somewhere. We still haven't actually cracked it. We've got one bit going, but then there's consequences that you say, well, the gate's there, I'm sorry, we've done our bit, we're absolutely brilliant, but they've got to improve their bit. But from somebody looking at this, it's trying to understand the full picture and all of the other consequences. Thank you, Mr. Chairman.
Thank you, Dan. Please.
Thank you, Mr. Chairman. Carbon capture is great, but nature needs a balance. And anyone who's been in a spruce, and 70% of your timber is softwood, basically spruce and larch.
And pine.
And pine, all closely going together. So if you don't get too many branches, you get good clear timber. You totally kill any biodiversity in that wood. Now, I noticed that you were saying that you're going to have little channels of biodiversity, but aren't you doing enormous harm to large areas, especially by totally killing off any other form by capturing carbon? Great. Put a model lorry, which then burns a lot of carbon and getting it to a port, but ignore that. But I am concerned by this overpopulation this world has, planting up everything, pines and firs and spruce and larch, and the forest floor is dead.
Sure. So when we look at the land that we have is a very low level of biodiversity on it. So we're not doing any land clearing of any natural forest. So we have a zero tolerance of land clearing. So if there's any remnant forest on those areas, so effectively what the land is just low level pasture.
But low level pasture has a level of biodiversity in it. Once you planted it up, that's gone.
Yeah, I mean, I suppose that the level of biodiversity amongst foreign grasslands, it's different if it's natural grasslands, so it's not natural grasslands, but even those areas, it typically is fairly low. And similarly, even once we've established the plantations on 70% of the land, that land actually, what we've found, it actually acts as a buffer to the remnant vegetation and a buffer to the streamside reserves that we plant. And so you find often that the flora and fauna does interact and move between the commercial plantation and those streamside remnant vegetations. So it actually provides quite a strong buffer to the protection of those areas. That's been our experience as foresters.
He says it because well, we've got photographs of acres and acres, or hectares and hectares, that is, of closely planted forestry, and you know that nothing else is going on in there.
Yeah,
and carbon capture, which is great, but
I mean, the options are, and I suppose this is part of the trade-off within the fund itself. So we have a 10% allocation to natural reforestation, which is mixed species. But the problem we have with mixed species is that there's no inherent value if the carbon markets don't work. If the carbon markets, for whatever reason, don't occur, then there's zero value. Yes, you do get biodiversity value, but zero return for the investors. And so what we're really trying to get is that right balance of protection of returns for the pensioners investing so that they get a base return, which they get from the commercial plantations, adding to biodiversity through the streamside reserves, but then also providing net carbon removal. And so when we look at that, it's not just the returns, but the other thing is the costs. So when you look at a plantation development relative to natural forest restoration, plantation development is about half the cost, but it provides 4 times the carbon credits because of the growth rates. So everything is a trade-off. You know, you can't just say one's leading to one and one to the other. Every change of land use is a trade-off. But what we're looking at is we firmly believe that the trade-off from low-level quality pasture that's been cleared land to the establishment of commercial forests for wood production and natural forests is a huge net benefit on those particular properties that we establish. And the areas we're establishing are very low level relative to the overall landscape.
And Stephen, sorry, I'm not.
sorry.
Sorry.
Sorry, apologies. So hopefully that should work. I think it could also be worth referencing the fact that we will be going in and establishing a biodiversity baseline across those land parcels that we will be buying up to plant, and then measuring that on an ongoing basis. I suppose it comes back to that old adage: if you can't measure it, you can't then manage it and enhance it. So these will be biodiversity positive investments ultimately.
Yeah, the chairman shows that is a problem, and hopefully it's being slightly addressed.
Yeah.
The other thing is, and you slightly alluded to it, carbon credits are a bubble. It may burst at any stage, mightn't it? Do you think it's got a long-term future?
Definitely, we wouldn't be investing in it if we didn't think so. And when we say bubble, it'll be a market that has volatility. It's a brand new market, and so, you know, to invest just into carbon credits, then you should expect volatility associated with that, and you know, there's uncertainty around that, so it's quite a significant risk. But to provide that with a base return of 6% from the commercial plantations is the floor that we say we can't go below 6% for the pension investors. That has to be a base, but there's considerable more upside. So this is part of the reason why when we recommend a portfolio, we say somewhere around 60 to 70% in our traditional funds, which are providing an 8% return on the commercial forests. But then the carbon fund should be somewhere around about 30 to 40% commitments. So you again, even between the funds, you're getting a balance. Yeah.
Thank you, Lee. Nick.
Talk about the asset sales. Presumably that means the sales of the logs, and presumably also the sale of the plantations effectively in the land. Who do you sell the land to at the end, and how do we ensure that even if you've done all this biodiversity, that somebody who comes along and then says, "Right, well, let's chop them all down and put some cattle on it"?
You want me to take on that one? If you want. Yeah, I mean, when the lands are planted, in order to register the carbon credits, the commitment to maintaining a property of forests or a forest property is in perpetuity associated on the title of the land. So you're not entitled to purchase that land and clear the land. If you do, you have to rebuy back the carbon credits that were sold off it. So that is, I suppose, an impediment for the buyer. But the buyers that we're looking to buy are existing plantation forestry companies who want the wood for their commercial wood. So they will intend to buy it for the sake of growing on that plantation and re-establishing it over time. So for them, that's not really a liability. So that's the end market where we're looking to sell, but there is a commitment on title that's a legal obligation to ensure that it is replanted. Yeah.
Okay, thanks very much. Mr. Denny.
Yes, a couple of points. As I know New Zealand and Australia reasonably well, the pasture land is monoculture. It is pretty poor quality. I wanted to ask about the time to market compared to softwood for hardwood. How long do you have to invest to get that return?
So the hardwoods would typically come to market over a shorter time frame than the softwoods would. Obviously, I mean, the softwoods we would be looking at rotation lengths of around 30 years. If one is managing pulpwood, softwoods would grow. Yes. So we'd be growing the softwood trees over a period of 30 years plus before they are harvested. The hardwoods that we're looking at are not hardwoods such as oak, beech, birch, this sort of thing. That we are looking more at in the scope of our fund at eucalyptus plantations. Those can be managed either on a shorter rotations of 8 to 10 years for pulpwood, or over longer periods for use in producing saw timber and longer lasting products such as that. And it's that form of management that we're focusing on more within the context of our carbon fund, recognizing that that's a more effective way to store carbon.
And presumably for your big plantations, you've got wide fire breaks, which is another wildlife biodiversity corridor.
Exactly. So what we're looking at from a landscape perspective, of having something of a mosaic with fire breaks plus corridors that are based on physical features such as rivers or streams, but with buffers either side of those that form multiple functions or purposes. They're there to facilitate movement for wildlife and fauna and flora. However, they're also serving a practical function in terms of forest protection.
Okay, thanks very much. Has anybody got any other questions? No? Well, really interesting presentation. I think you've been tested by the questions. I think certainly it's highlighted my level of ignorance, and I'm sure we've all learned a lot. Thanks very much. Thank you. Thank you very much, Steve, Mike, and Dermot.
Thank you for your time. I mean, we look forward to sort of showing these plantations and areas as they grow. So it's going to be quite exciting, I think, what we can bring forward as we come back over the years. Thank you.
Thank you. Thank you. Thanks. And I shall now take agenda item 11, LGPS central update. Is the committee in agreement with that?
Sorry, if I could just jump in. I'll be coming along with the with LGPS Central in a second, but we sent through the ESG report supplement, but we'll also need to look at the original presentation that was sent through. I don't remember exactly how many slides that was, but it started off with just the Leicestershire County Council Pension Fund title slide.
Okay, thanks very much. So I welcome Gordon Ross, Patrick O'Hara, Mr. Sala, Matthew Jones and John Burns. We also, as you've just discovered, have Jack Young online. Ulesh, if you could introduce the report, please, and then we'll follow it up with Central's presentation.
Thank you, Chair. I'll be as brief as I can. So, like the previous paper, some background. The fund has invested in a number of Central products, which as of the 31st of March were valued at circa 2.2 billion. The fund has also another 900 million in collectively procured pooled low-cost passive funds with Legal & General, which some may class as pooled. Point 6 on your papers highlights, as at the 31st of March, 11 products in total that we've invested with Central, 12 if you include the direct property product, which hasn't had any money called yet. The numbers in that table don't include any outstanding commitments to private market investments, which are yet to be called. And as such, the absolute value of pooled assets should increase over time, all other things being equal. Central do have a slide, I believe, which highlights those uncalled commitments as well. I don't have anything else to say unless there's any questions.
Okay, so we're just going to go straight into the presentation. So, gentlemen, I'll leave it to you to order who's going first.
Thank you, Chair. I'll go first. I'm John Burns. I'm the interim CEO at LGPS Central. My colleagues Gordon Ross, who's our CIO, Patrick O'Hara, who is head of our Responsible Investment and Engagement Group, and Bashir Salah, who's a manager in the Responsible Investment and Engagement Group. And you've heard Jack Young on the line, who's one of our analysts. We'll just take you through, I've got a little piece on a little bit of an overview of pooling, or where the whole concept is today and where we stand with Leicestershire in that profile. Gordon will take us through the investment performance, and we'll talk about some climate risk developments that are happening with the RINE space. To turn to page 4 of the deck, this just demonstrates pooling as a concept as it's moving forward. We started in 2018, just seeing where we are as a pool against all of the other pools that are in the UK. So it's a strange diagram, but the left-hand side basically shows how pools report their assets. But if we focus on the right-hand side of the tables, this essentially shows all the pools in the UK on a like-for-like basis. So it's not only the assets that all the pools have under management, but it also includes, as Ulesh mentioned, the passive funds, which are held possibly outside of LGPS Central, but are classed as pooled because the partner funds have engaged with, in our case, LGIM, to create a pool of funds which are generating good rates. So on the right-hand side, you can see there LGPS Central is pretty much 80% pooled when you look at it on that basis. A good place to be across the other pools around the country. The two on the right-hand side, local partnership, pension partnership, and Northern LGPS, slightly different structures in that Northern LGPS runs money on behalf of Greater Manchester, Liverpool, and West Yorkshire under a more of a discretionary approach. They don't have an FCA company. And then local pension partnership, a similar arrangement, but they are regulated and by the FCA, as we are, and they run money for London Pension Fund, for Lancashire, and the infrastructure fund GLIL. So slightly different. That's why their concept is different. So they're representing that they are wholly pooled. Turning the page over to page 5, just to look at our own pool and where we stand. You can see over there towards the far right, Leicestershire's assets, substantially 50% pooled with us, which is excellent. All of the partner funds are invested with us to varying degrees. but all have a commitment to move assets over as soon as they can. You may have heard, if I just turn over then to page 6, you may have heard some of the chatter about where pooling will go. There were some interesting announcements in the spring budget by the Chancellor, really wanting the pooling initiative to really take more initiative to move to the pooled assets as quickly as possible, but clearly without significant direction, without any particular guidance from government as to what they want. I'm afraid that we just have to carry on and continue to build the pool as we have been doing, investing the assets as they come available, and as we build product with our partner funds. It's there will be continued pressure from government and Treasury to increase the pace of pooling. There's one particular group which is working with government. It's the Capital Markets Industry Task Force. This is a significant project by government to work out how we can make our capital markets more competitive, how we can provide capital for investments to grow the economy, and particularly the current issue is the competitiveness of the London Stock Exchange, and how it's losing competitiveness globally to other markets. And we fall into that initiative by the Treasury. They look at the pension funds, not only defined benefit, but also DC funds as a source of capital that can be used in particular for venture, for startups, and for local investment. So the push from government, from Treasury, will not go away. And really, for us to be successful as a pool, we really need to make sure we continue to commit to the initiative of pooling to make it successful, so we can be in charge of our own destiny and not have to bow to the needs of government, which is clearly important, but also we have a responsibility to the LGPS fund itself and the legal structure that stands behind that. So I'll leave it there. That's my piece on where pooling is. Happy to take any questions. Otherwise, we can move on to Gordon's comments.
I mean, just for clarification, the government doesn't have the right to dictate where LGPS, whether centrally pooled or otherwise, has its investment. I mean, that isn't the case unless they pass legislation, but that would seem to be quite contrary to the principles of what this committee is doing. In other words, we decide where it's invested rather than having a local government do it. I understand what you're saying about the capital markets and competitiveness, but it seems, I suppose, in honesty, if the government were to underwrite guarantee returns which are equal to available to the ones you were able, that would be something we could consider. But I think there's still a long way to go on that. Am I right, John?
Yes, Chair, that is right. I think the protection that we have as the LGPS, it means that we are masters of our own destiny, and I think there is a long way to go, a lot of negotiation. And
thanks very much, Nick.
Just to reiterate and totally agree with you, Mr. Chairman, that, and I'm reassured by your sort of response about not bowing to the needs of the government of whatever political complexion, that these are our assets, not theirs, and that therefore we should, that can assure us that the decision whether we want to invest in something is based on the best return and the safest return for the members of the pension fund, and not what the government wants us to do wherever. It might be what we want to do, but it's our decision based on our assets.
Yes, that's the position that we would take, and I think that the strength that we have, not only with the LGPS, but also the strength of the pool that we're creating with the assets that we have, mean that we are also a stronger voice and a louder voice collectively to be able to have those debates.
Thank you. No more questions. I'm just asked to carry on.
John, thank you. Chair, thank you very much. Good morning, everybody. I'm Gordon Ross. I'm in charge of the investment department at LGPS Central. The next two slides are about the funds we've pooled under an ACS structure, which is a structure they're held in. And so on slide 8, you can see the list of the funds that we have. As Balesh said, some of them are passive, which means they replicate an index, are not meant to add anything beyond that index. Others are active. And the third group is in what we call a private market, so less liquid instruments, such as private equity, private debt, whereby the custom normally is we choose the manager, and the manager will commit monies from yourselves and other partner funds within Central, and those monies will be invested over time. So when you hear references to the commitment and then the investment, that can be a period of time whereby the manager is finding the best opportunities. You can see on slide 8, as I said, the list of the public and private markets funds we have, not only their total size, but the size that the County Council Pension Fund has in on that. And again, different percentages of total funds. And the combination is just under 2.7 billion of assets across all the various funds that we have. On slide 9, more importantly, the performance. Again, we've broken it into two areas. As I said, the first one is the passives. We measure that not on the performance because they're meant to replicate the index. They're not meant to outperform an index. They get exposure to a market by replicating the index. And we measure that on a thing called a tracking error. And that's the variance between how close they replicate the index. In all cases, the passive funds that we have run at Central, of which you're invested in one, are basically replicating the index, and the amount of variance or difference is very, very small. Hence, they get this green status on a RAG status. Below the line, you have the publicly quoted investments. These are all in active funds, and we go from active multi-manager funds on equities, on fixed income, and then the last three that are listed, although not invested in currently by yourselves, are some thematic funds on sustainable. We grade them red, amber, green. Green means they are outperforming a target and the benchmark. Amber is they're outperforming the benchmark, and red is they're underperforming. This is at the moment in time. This is as at the end of April. If I was to flick you through to where we are now, for the funds that you're invested in, the active investment grade corporate bond fund would now be amber. And the the multi-asset credit fund would be verging on amber, but not quite yet. So investments and performance is improving. Obviously, we'd like to see green on all of these at any period. It is long-term investments. We do have one of our oldest funds, which was the Global Equity Fund. It's now, it started within a year of us being created. It now has a rolling 3-year performance, which is something the industry, the asset management industry, looks at. It is now top quartile, outperforming both its benchmark and its index. So it's doing what the managers are doing, what we wanted them to do. The fund is doing what it was designed to do for yourselves and other partner funds that are invested in it. I'm quite happy to take any questions, Chair, that you may have.
Balesh.
Gordon, would it be helpful if you were to explain the kind of changes that are going on? Use the global equity mandate as an example, now that you've reached 3 years.
So obviously on any mandate, both public market and private markets, once we've chosen the managers, that's not it. We continuously monitor the managers, we talk to them and review their performance, because we've chosen them for what we believe to be their belief in the markets, the process whereby they invest, and the people that invest. And philosophy, people, and process are the 3 Ps that people normally will throw out as far as that's what makes a good recipe, because performance will fall out of the bottom of that. On the equity side, there is within the ability to, within the process of running money, there is what's called a style bias. People, investment managers, asset managers tend to have a bias on certain strengths they have. We create these funds on the equity side. We have 3 managers typically. It could be, and it will likely be more, because we look for a blend of managers whereby in any environment, the ideal world is to have performance continuously outperforming, not dramatically, but on a continuous basis, because we want to have added value, but with low volatility of performance. You don't see numbers all over the place all the time. So Balesh, one of the things he's talking about or hinting about is that we're currently looking to add a 4th manager. to our global equity fund. And this will fill what we call a star gap. We have a manager who's more value. They're looking at companies which generate value. We have another manager who's a growth manager, so looking for companies that have their business is growing and their performance comes from growth within those companies. And we're looking for somebody who has quality. Now, this is a group of investments, and sometimes companies can be blurred between the various stars. But the quality manager is something that at all times is there. That those types of companies in any environment will give you a return that is an added value. They have something that is either suitable for a growth economy or a value economy, an economy where rates are going up, rates are coming down. And so we're looking to add a manager to make sure that we have that blend of managers, which will ensure the continuation of the performance of the fund on a continuous rather than volatile basis.
Thank you, Ulash. I think it's good point.
Probably confused you more than added value.
No. Thanks very much.
That's it. I have nothing else. Is there any questions?
So, has anybody got any questions or queries on that? No. Okay. So, Patrick, over to you.
Thank you. The opposite to being on mute, I guess. Thanks. Yeah, so we just wanted to give you an update on the work we've been doing on climate reporting and ESG reporting. I think we mentioned in previous committee meetings that we've acquired an ESG tool that's going to help us do what we do a bit more completely and a bit more robustly. It has various applications, which I'll talk a little bit about today, and we'll give you some of the some examples of the reporting that we're developing that we think is going to be beneficial to the pensions committees that we service. But moving on to the next slide, I would point out that this is still a work in progress as a phased implementation of this, because there are a number of different applications that we can use this for. If you look on this slide, you'll see over on the left-hand pillar, on the environmental pillar, we've been able to produce some climate change reporting, but it's predominantly focused on scope 1 and 2 emissions, which we know is an incomplete story. I've done a little bit for you on maybe natural capital and environmental opportunities in your portfolio, but by and large, that's all that we've been able to report thus far with the data that we've had access to. Now, the acquisition of this tool is going to enable us to open up those other pillars so we can look through the portfolios that we manage and analyse them. So the environmental pillar, the social pillar, the governance pillar, so complete ESG coverage, just to give you a rough feel as to what's in each pillar. So obviously climate is in the environmental pillar, but also our much more immediate climate risks like pollution, waste management and issues like that, other sorts of emissions as well. And then under the social pillar, we're talking about modern slavery, human rights. We're talking about the impact that companies have on their local communities and how they manage that and how they interact with local communities when assessing projects and opportunities. And then the governance pillar is very much about how a company is governed, and that includes also corporate behaviour. So things like bribery and corruption, ethics, fraud, and those sorts of management of business risks. So we're now going to be able to report on that. And this is going to help us with our engagement prioritisation. So when we sit down at the beginning of the year and decide our priority engagement companies, we can analyse the portfolios and see which companies are showing the highest risk across these different metrics. We maintain a watch list of companies that we want to keep an eye on, and that, again, this analysis informs that list that we're able to now assess and identify much more comprehensively and much more scientifically. The due diligence that we do on new managers, well, we can look at their existing portfolios through this lens and challenge them on some of the challenges that the companies that they hold are facing through an ESG lens. And we're also, when we do our quarterly monitoring of companies, we also challenge them again, and this is ammunition to take to those meetings. What we're really trying to do here is to understand the manager's approach to ESG integration and make sure that it's what they told us they were going to do at the outset when we appointed them. And just generally, there's a lot of information available through this toolkit that's going to help us to keep up to date with emerging issues and controversies in different sectors. And all this is going to lead to a more robust delivery of RI.
Marlies, yeah.
just if you find that a company is a laggard, but actually making enormous profits and making a lot of money, there's a balance, isn't there?
There is.
Where do you strike the balance?
Yeah, there's a number of things there that a company may be very profitable and very successful in many respects, but if they're not managing their ESG risks appropriately, that portends a potential future risk for them. And if it's a material risk, it could affect revenues and ultimately could affect share price. So we would engage with those companies. We would expect the managers to engage with those companies to understand those risks and also to factor them into their valuation. So when they when they do their modelling of a company's future revenue streams, well, how have they modelled these particular risks into that? So all of this is really designed to make better investment decisions, better informed investment decisions, to look beyond the financials of a company when assessing its risks and opportunities, to a more broad set of risks and future risks, and also to take a bit of a longer term attitude and approach to assessing those risks.
Thank you.
So if you could move on to the next slide. I won't dwell on this too long because I think, well, Jack's going to talk a little bit in more detail about the reporting that we can do. Just a little bit about the methodology here. The way MSCI approaches, and MSCI is the vendor that we've appointed through our due diligence process for this, and it seems to be the industry leading provider. It seems to be adopted quite broadly across the investment management industry. They assess a company's performance against its peer group. So they will compare mining companies against other mining companies, and they'll assess integrated oil and gas companies against other oil and gas companies, banks against other banks. So you get a relative picture of how the company is performing within its peer group, which is the most relevant kind of intelligence that we can have. And what they will also do is assess, well, what are the material risk factors relevant in each sector? And they assess the company on those material risk factors for their sector. So risk facing a bank are very different to risk facing a mining company. Banks don't have the same exposure to water intensity issues or health and safety as a miner does. So it's appropriate that companies get assessed on risks that are relevant to them. And then that all gets calibrated up into an overall score. Whilst we don't get overly involved in the ultimate score, it is a useful indicator. We're much more interested in the data and the analysis below that score. And each company reports, so each company gets one of these ratings. And each company report is 40, 50 pages of data and intelligence and research into that company's management of ESG risks. So we can then do portfolio comparisons, so compare the performance of our portfolios to the benchmark. Because our managers are expected to integrate ESG into their investment processes, we would expect them to be heavily tilted towards better performing companies. If that wasn't the case, that's a conversation we can have with the manager. And equally, what we can also do is analyze the ESG ratings momentum, so we can look and see how the scores are performing. And we would expect companies to improve over time for various reasons. But we can identify where a company's score is deteriorating. And again, that's a opportunity for engagement, a conversation with the manager to understand why that's happening and how they factor that into their investment processes. This all also feeds into our voting, so we can vote against management if we feel that their management of any aspect of ESG risk is inadequate. So again, that's another usage of this. I'm happy to pause for any questions at this point or
Nick, already got any other questions? Oh, Mr. Danny.
Yeah, you didn't mention politics there or dirty words, and I'm conscious that commodities is a great hedge against inflation, and yet the investment in people like Shell is politically not very welcomed, but they invest a lot of money into research to find themselves a product down the line.
Yeah.
And if we're still invested in them, we have the influence over them we wouldn't have if we pulled out of it. So I'd like your take on that sort of situation.
Well, I would tend to agree with you. And the beauty of this analysis is it is a little bit agnostic in that sense. It doesn't make a judgment call that finance and tech are good. It does very much compare companies within their peer group, and it will look to companies like Shell and BP, and it will look at what they're doing in terms of managing their carbon emissions, how they embrace renewable energy and other technologies. But it does look at their risk exposure based on their specific portfolio of assets and how they're managing those risk exposures. So it's kind of tries to leave the politics out of it, and looks very much takes a very much a risk-based approach to assessing those things.
Okay, thank you, Patrick. Any other questions? No? No?
So, yeah, sorry, moving on to the next slide. I think it's Jack now. Who's just going to give you a run through some of the reports that we're developing, that we're going to utilise, bring to partner funds, enable them to analyse the portfolios through a broader lens.
Thank you. So over to you, Jack. Jack.
Thank you very much, Chair, and thank you very much, Patrick. Yes, I'm just going to talk through a little bit about the ESG report that we're in the process of designing and creating for the partner funds. Before I go too much into it, I want to flag that you are the first partner fund to see this, and everything is very much in early stages. So metrics might change, and this is very much a sort of early look. Also, the figures that you're about to see, they are real, but they aren't for Leicestershire or necessarily reflective of Leicestershire's holdings. So yeah, just to be used as a trial. So we'll start with the potential structure of the report. There's a couple of things I want to draw your attention to here. First, everything we think will be at a fund level overview, and that will be on E, S, and G, those three pillars. And then we're going to deep dive into each one of those pillars. And in those deep dives, we'll be able to use specific metrics. So, for example, environment. We'll be able to tie in quite a lot to TNFD and look at biodiversity risk exposure, potential impacts. On the social side, we can look at human rights and potential tech controversies as well. Governance, we're going to also include a high-risk sector analysis. And of course, for each of these pillars, you have different sectors which are maybe more at risk of significant ES or environmental or social risk factors. So through the high risk sector analysis, feeding into what Patrick was just saying, we'll be able to facilitate a peer analysis, and that will be really useful. You'll notice that we haven't included that in the governance section, and that's because governance concerns are more universal and not quite as sector specific as environmental and social issues. And we're also going to include some engagement case studies, and this is really just to sort of demonstrate, how we're working to improve these impacts and mitigate these risks. So if we move on to the next slide, Patrick, I think, mentioned or talked to a couple of these points before, but just to give you a little bit more information about what these metrics are and how they work. You'll see for this trial portfolio that both the portfolio and the benchmark are rated A, which is quantified in the center graphic. These scores are out of 10, and you'll see on the far right, or you'll see that there's quite a difference between the quantified numbers. And on the far right, you'll see that actually the portfolio is very close to being upgraded to a AA portfolio, while the benchmark is very close to being downgraded. So you don't get just the grade, but you see where it is in relation to that as well. The other thing that I think is particularly valuable is this ESG ratings momentum graphic, which looks at all of the companies in the portfolio and looks at whether they're improving from an ESG perspective or they're moving backwards, they're going downwards in their ESG grading. And that's a really good indicator of the direction that your portfolio is moving. If we move on to the next slide, I think those are the key ones from there. Now, this is something that's really exciting. We're really excited to be able to bring this to you. This is the impact scores. So we've been looking at risk for quite a long time in different areas, but of course we can also have a positive impact through the investments that we make. Environmental impacts, we can see, and social impacts on the left. Examples of the environmental impacts we can see, such as sustainable water, pollution prevention, or sustainable agriculture. These percentages represent an extent of revenue exposure within the portfolio to companies that are providing products or services which looking to better environmental and social problems. Typically, anywhere up to 5% would be low impact, 5 to 10% would be medium impact, and above 10% would be quite high impact. This trial portfolio is not an impact focused portfolio, so you'd expect figures like this. And these figures are based on a lot of raw metrics, which we'll be able to look at in a bit more detail later. And you can also see this international norm compliance. Unlike the impact scores, here you're going to be looking for the lowest percentage possible. And this is tying into the Global Compact compliance, human rights norms, and so on. So we have quite a lot of scope there. If you could now move on to the final slide of this supplement. So as I mentioned earlier, one of the exciting things is that we'll be able to provide a high-risk sector analysis of different sectors and their impacts of those companies on ESG. Here's an example, again, real numbers, but example portfolio with some laggards from the oil and gas sector. And just to give you an example of the kind of metrics that we can show, we can see the ESG scores of each of these companies, which is very much in line with the graphs that you saw earlier. The environmental score and the social score, there's also a governance score. These are out of 10, and they're particularly focused on each of those pillars. And they're sort of culminations, I suppose, of all of the raw metrics in that pillar. Moving on to the right, we can see some biodiversity specific metrics, operations in geographies with highly fragile ecosystems, number of biodiversity controversies. We have here nitric oxide and sulfur oxides emissions, all very important biodiversity metrics. And although not immediately compatible with TNFD, definitely will be very useful for TNFD when we start reporting on that in the future. And the final pillar there, we've got fatalities for the company's employees, which is a really useful social metric. So this is by far an exhaustive list, and you'll see that there are some perhaps gaps in the data, and this is perhaps reflective of, I suppose, the sophistication of the data at the moment. So we're going to be looking through and trying to find the metrics which are most relevant to a portfolio analysis and most insightful for you as well. So yeah, that's a very quick insight into how this report might look, and I'll be happy to take any questions if you've got them.
Thanks very much, Jack. That's very informative. Melise.
Thank you very much for that. I was interested, you're very good in the environment and social. Governments, you flick over a bit and you don't have a high risk category. Now, we've seen businesses going under because of governance faults. Why aren't you taking that sector quite as seriously as the others?
I thank you for your question. Governance, of course, is incredibly important. And I hope I didn't give the impression of skipping over it. It's true that in this early stage, we hadn't considered a sort of sector-specific analysis for governance, but that's more because governance issues, governance risks are very much universal. So in the potential structure that you could see in the first slide, we will still be giving that fund level analysis of governance. And there's a huge variety of metrics that we'll be able to call upon. We can be looking at things like board diversity, board structure, remuneration policies, and many more. So although we might not be focusing on a sector-specific risk, that's absolutely not to say that we will be glancing over governance, because you're absolutely right. There's lots of examples of companies which are suffering due to poor governance, and it's very much something that we want to remain on top of.
I think you're right. I mean, I think investors have taken their eye off the ball, I think, a little bit on governance and focused on climate and other aspects of ESG. And it is a very immediate risk that, we're at your peril.
Is there a chance you might introduce the high risk category into governance, which was left off on the slide?
Yeah, definitely. Yeah, this was a bit of a mock-up, and governance will definitely be represented in the report we did for partner funds.
Okay, so we said that.
Is there a question there?
I'll come to that now.
All right,
Yeah, I've got him. Yeah.
Just to extend that last point, geopolitical problems and governance at government level, the actual countries, there's no metrics for actual risk factors for which sort of country you're investing in.
Yeah, we can do that. We're invested in sovereign bonds, and MSCI do a country risk rating, which we use to analyse our sovereign bond portfolio. And that's a good point, that you can use that to then analyse some of the corporate risk, because the country is located in a certain jurisdiction and all of its operations are in another. Geopolitical issues are very relevant there. Again, I don't think investors on the RI ESG side that necessarily capture those geopolitical risks very well, like China and Russia, for example. So that's something we will certainly use on the sovereign portfolios, but potentially extend it to company analysis.
Good.
Jeff. Thank you, Chair. First of all, apologise for my lateness and for the fact I wasn't here in the section about declaring an interest. So I'm now a member of Charnwood Borough Council. So I don't know whether that was reported earlier. But anyway, just to say that first. Okay, so we're seeing there that BP is scoring low on environment, only 4.6 or 5, is that, out of 10. I mentioned before, when I went on the LGA's Pensions Fundamentals course, a leading investment manager, Bailey Gifford, offered the very strong view, actually, that BP seem incapable of pivoting to renewables in terms of their business model. They're just not doing it quickly enough. So there is a big question about these big oil companies, even in the minds of some well-respected investment managers. I just really wanted to say, it's important, I think, that this reporting does actually, I'd really be looking for a reassurance, really, that you feel that this reporting tool that you're now going to use is really going to show up those companies that actually are a long-term risk for this pension fund from an environmental perspective, because obviously I would be very concerned if that's this new reporting approach that you're going to use on our behalf.
I mean,
didn't show that up.
That is one of the intentions here, and Bash is going to talk a little bit about what we're going to do to the climate risk reporting. We are conscious that we're very focused on scope 1 and 2 emissions, i.e. the operational emissions of a company. It doesn't say much beyond what they're doing in the future to transition and how their transition plan actually stacks up. And it doesn't say, it doesn't comment on whether a company's business model is positively positioned in terms of the transition or negatively transition, both in terms of a business risk and in terms of their impact. So we're trying to add some additional metrics in that give a bit more of a holistic view. I would say that I'm not aware of any integrated oil and gas company at the moment that's doing enough. I think Enel and Total might be leaders now, but I still think all of them have more to do to accelerate their transition. There's other factors like government intervention and government incentives and government policy that are going to be required, I think, to make that happen at the pace required. But all of this analysis and these numbers, when presented, need to be explained in the context, and there will be narrative to go with that. So this is all an attempt to give a more holistic view of portfolio exposures, risk management, and the future trajectory of these portfolios beyond scope 1 and 2 emissions, which is currently what we focus on very much.
Thank you, Patrick. Yep. Any more questions, Nick?
It's almost more of a comment, really, but in terms of risk management and governance, is the phrase that I take to account of is Mintz. Can you take the hit? And if you can't, then there's something wrong. And that's happened with one or two local authorities nationally as well.
So, I mean, that's for the portfolio manager constructing the portfolio to make sure that it's well diversified and not a single exposure to a particular company and an event like you just said. It's also up to them when they analyse and do a deep dive on the companies they select in the portfolio. they've got to have a view on management, they've got to have a view on the governance of the company, and they've got to have a view on existential risks as well as risks within the business model. But this is supporting that and affords us an opportunity to challenge them on those assumptions, decisions that they're making where we think they may have missed something. But that should be fundamental to the investment process of all regulated managers.
Okay, thank you, Patrick. Any further questions? Good, Zubair.
Thank you, Chair. Really positive to see this development. I just have one question. We as the committee will see the report in its finished form.
Yeah.
We use those to inform decisions. But the interesting point, very important, is assurance around the integrity of the data that goes into preparing these reports.
Yeah.
And sort of what's the process around just ensuring that the data is accurate, complete, and the integrity of that data, because that has not just on that side, it also from a governance perspective, organizations have sometimes failed because the data they've looked at was not quite right. So I just wanted to understand if there's a bit more you can shed light on that.
Yeah, I can. All of the data that's in these reports is in the public domain. It's publicly disclosed data. Some of it is disclosed by the company, which you have to take with a pinch of salt. And some of it is about industry level disclosures and stuff like that, government policy and litigation and matters such as that. So it's all in the public domain. Behind every rating here, there is an analyst at MSCI who analyzes the company in the sector and analyzes the data. Now, for example, on carbon data, if MSCI don't have confidence in the carbon data that the company is reporting, i.e. they know its way out, they'll ignore it and estimate it themselves because they think that gives a better reflection of what the company's actual emissions really are. So there is that, that process. Any company that's rated CCC goes to a committee at MSCI to agree that that's an appropriate rating. There is an opportunity for companies to respond to MSCI's assessments of them, and some companies do that and some companies don't. Got to be careful there because you don't want to give companies an opportunity to influence their ratings, because that's not what this is about. It's independent. So there are mechanisms in place to try and manage that. I think inevitably you'll get the sort of fraud events that are very difficult for anybody to predict or understand. Even forensic accountants miss these things, so there will be some of that goes on. But I think there are pretty robust controls to try and ensure that the data is based on accurate reporting.
Thank you.
Sorry,
Thank you, Patrick. Yeah, Zubair.
Just to follow up, thank you. What's the typical time like in terms of, is this real time or what's the typical time like in terms of the?
Yeah, so they do a ESG report, which is what we've talked to you about today, which is the company rating is reviewed once a year, unless there is a significant event like a tailings dam accident or a litigation or a fraud expose, then they will review the rating based on that in response to that. But they also have a controversy report, which is backward looking, which is very much more real time, and they will adjust that when a update to a controversy occurs. And that's more real time. I would say that probably may take a week or so for the analyst to assess the significance of the controversy and then make an adjustment to the controversy rating.
Okay, thank you very much. So
we have one final slide, which is on the climate risk report. Yep. Looking at this is a mock-up of what our metrics and targets section of the climate risk report will look like going forward. We have done a thorough review of the climate risk report. The objective is to ensure that our climate risk report remains relevant in light of the new Department of Levelling Up regulations on TCFD, as well as add more value to committees when it comes to decision-making process. We've used a tool called Power BI from Microsoft to integrate all the data. So we feed all the MSCI data into Power BI. We feed our holdings data into Power BI. And I'm happy to say that the integration is 90% completed. So hopefully the report can be published soon enough. What we can get from the new enhancements is that data coverage is much better because we've mapped security identifiers better. And also we've added new data like sovereign intensity. So your sovereign holdings will have some sort of analysis into it as well. We also have better granularity. Instead of, in the past, we always group funds into, buckets. Let's say LGIM is one bucket, LGPS Central one bucket, and so on and so forth. We will do a fund by fund analysis that will help us with decision making, with engagement with managers and stuff like that. So that will hopefully help pension committee as well as LGPS Central here, because we need to know what we have to engage our managers on. A little bit of work in progress going forward is our private markets. Right now, live when it comes to work in progress is our private equity co-investments and the private equity portfolio. We're hoping to integrate this as soon as possible, hopefully this year, if not, definitely next year. And what we do is we'll speak to Bulesh and Kat and kick off the data collection pretty much immediately. There's no additional data requirements from Leicestershire. It will be the same. And we will continue to report based on the TCFD as the basis of the climate risk report. But as you can tell, you will get a little bit more enhanced climate fund report and perhaps enhanced climate stewardship plan as well. Maybe I'll just go through my thoughts on what's additional to previous years. We've had finance emissions in previous year. Basically, finance emission is the emissions from companies that we own, emissions that are caused by our investments, so to speak. We also add additional normalized finance emission, which is finance emissions over our AUM. So it's easier to compare between funds, how the funds are performing when it comes to emissions. We are also planning to add Scope 3 finance emissions, as well as Scope 3 finance, normalized finance emissions. And you get coverage statistics on each scope. So you get Scope 1 and 2, how many percent of the companies within those portfolio is covered, has data, and how many percent does not have data. In terms of weighted average carbon intensity, which is the risk of high emitting companies within the portfolio, we will be adding sovereign data into it. We'll use country GHG intensity per GDP ton per million, for example, and you will get data on how your sovereign investments are doing when it comes to carbon intensity. We will be showcasing 10, as you can see here, 10 of the worst emitters. In the past, we've always shown 5 based on finance emission and 5 based on weighted average carbon intensity. That means sometimes you only get 7, 8 companies. Now we're going to give you full 10, and we'll be showing a lot more data at company level, Scope 1 and 2, Scope 3, perhaps even implied temperature and the climate value at risk, which I'll talk about next. Climate value at risk, it's not shown here, but it's something that we are contemplating. Climate value at risk is basically almost like scenario analysis. We'll use the NGFS scenario as a basis to what climate value at risk will show us is at different scenarios, what is the value at risk, how many percent of the market value of those companies has the potential to lose value because of transition physical risk from climate. We are still reviewing the data from MSCI and calculation from MSCI. Hopefully, if it's robust enough, we will perhaps include this in the report, but otherwise we will work together with MSCI to come up with something better. And the other one that we're looking at is implied temperature rating. Implied temperature rating is a simple, intuitive, single figure, forward-looking assessment of a company showing in 30, 40, 50 years' time what would be the temperature rise caused by the company. So, for example, Shell has a 2.5%, 2.5 degrees implied temperature means Shell's activities as well as its decarbonization plan will cause 2.5 degrees of temperature rise in 2050. So we will use that. Again, something that we're working with MSCI when it comes to robustness of their calculation and making sure that we're happy enough with the way they calculate the implied temperature before actually using it to make informed decision making. So these are the type of things which we are hoping to do, and hopefully it will add a lot more value to the climate risk report. And it also informs us when it comes to engagement with our managers, with the companies, and when it comes to asset allocation decision as well. Next step, when it comes to modeling, I've talked about Power BI. The beauty of Power BI is that we know how MSCI produces the data and displays their data. So what we can do is, going forward, Jack has shown the ESG report. We can feed the raw data of those ESG data points into our Power BI model and come up with different pages, so different themes. If you look at the ESG report, climate risk report covers the one part, the environmental pillar. So we'll have natural capital, social and governance pillar as well. Easily we can feed all those data into Power BI and hopefully come up with a full stack of ESG report for each fund. And hopefully that will add a lot more value to pension committees going forward. That's all I have. Any questions?
Thanks very much, Miles. That's quite impressive. The way we're going, and obviously there's work to be done, but it definitely shows that you're taking all the issues very, very seriously. Has anybody got any other questions they'd like to ask? No. Okay. Well, thank you very much, then, Patrick, John, Gordon via and Jack online. We will much appreciated coming along today and for your report.
Thank you.
Thank you very much. Bye.
I think, committee, we'll just have a 5-minute comfort break, if that's okay. All right. Okay. All right, so I'm conscious that we've been going for 2 hours, so we're going to move on to the next item on the agenda, and hopefully we'll move through these items fairly quickly. So we're now returning to the order agenda. Item 9, summary evaluation of the pension fund investments on pages 53 to 66 of the agenda pack. Bolas, if you could introduce the report, please.
Thank you, Chair. So on to the standing item each quarter. So crudely, fund performance this quarter, focusing on property as well. Point number 2, we've got the standard table that you can see there. If you've got it in colour, it'll make a bit more sense. We've got 2 asset classes that still show double-digit returns over a 20-year time frame. So that's high yield and gold. Properties just dropped out, now just under 10% over that 20-year time frame. Kind of not surprisingly, given it's under 10%, given what we've seen in the property market over the last year or so. If you just have a quick look down those asset classes ranging from global equities down to gold, I've got little ticks on my table here to kind of denote that we've got exposure to all of those asset classes in some form or another. We even have a small allocation to gold within our rougher portfolio, which many of you will be familiar with. Point 3, portfolio changes in the quarter just ended. Hardly any. There was no need for divestments in the quarter. We had a really busy end to quarter 4 in 2022, where we rebalanced and made some top-up investments, specifically index-linked bonds and corporate grade bonds, which have, after the sell-off, provided a nice opportunity to get in back to target levels at lower cost. Point 4. The cash held by the fund, we tried to hold as little as possible. As at the quarter end, 69 million in cash, another 34 with Aegon for the currency hedge together. That's about 1.8% of total fund assets. Moving to point 10, overall investment performance. We do have the appendix at A, which is the portfolio evaluation report, the kind of big A3 doc that we looked at the other day. It shows performance by mandate for quarter, year, 3 year, and since inception. Point 13 has a little summary there of that huge A3, which just shows for the total fund, the quarter, 1 year, 3 year, and 5 year. We'll cover off a few parts later on as part of this paper. We've got robust 3 and 5 year returns ahead of the benchmark. We've got a quarter, we're just looking at 3 months here, where we were below benchmark by 1%, and that's covered as part of point 15. The in-quarter performance versus the benchmark of -1 is largely driven by investments within the growth asset class, which underperformed the benchmark. Now, part of that growth asset class has passive investments which hug the benchmark we had from Central earlier. So the underperformance only came from those active parts. The largest detractor in the quarter was from our private equity holdings, which declined by 6.6% in the quarter. Not really surprising given valuations for that private equity class lag those of the public markets. So you'll see the drop-offs in public markets, and then as valuations catch up in private markets, you'll see the drop-off. So not really surprising. Point 17, I'll touch on the -1.3% for the financial year ending. So that's the full year. It's the same as the fund's benchmark, so as we expected in a way, but it can be seen as a positive given all the negatives that we did see. You know, a huge equity sell-off during the year, accompanied by a bond sell-off, falling GDP, rising central bank rates. It kind of shows the benefit of diversification of our fund and staying invested at all points. Just going to move to point 20, which kind of spans 2 pages, that table, unhelpfully, so you lose the headings on the top, but I'll try and make it as clear as possible. We've got the 2022 strategic asset allocation as the first column, the 2023 strategic asset allocation second column. The change that was actioned as part of the January subcommittee, so you can see listed equities are -4.5%. The next column is where we are for the fund as at the 31st of March. And then the last column shows the difference to the 2023 strategic asset allocation. So you can see some fairly big numbers in that last column, which we aim to get to 0. In total, the changes were a reduction in that growth asset class, so that's the first 3 rows, and an increase in allocation to the next 4 rows, being the income asset group. In order to effect those changes, a schedule of work was agreed with Hymans. You can see at point 23A, 23A, B and C. A and B were completed and taken to committee in April. At the April's ISC, we've got another paper on today's agenda to talk through those changes. And the last point there, 23C, a protection assets review, is planned to come to next month's investment subcommittee. So that's the protection assets which cover index-linked bonds, investment grade credit, and the currency hedge. Probably a good time to stop while I get a bit of water. Any questions?
Thank you, Paul. Has anybody got any questions or queries on it? This is a standard report.
I've got a bit more to carry on. But
yeah. Carry on, please.
Okay. Pressing on to the property section, I'm just going to move over to point 24. Again, this one spans 2 pages. Our property holdings total 7.3% of our total fund. The target is 10, so we're a little bit underweight. We have got plans to get that back to 10%. We had a July subcommittee in 2022 where 120 million was committed to a DTZ managed product from Central. 60 million of that has now been committed. The gap between July last year and now, largely the fact that the product wasn't available to invest in, which has kind of helped the fund in a way. You know, we won't be investing at the top of the market, if you like, and money is now going in at arguably a better time. If we do get that 120 million away. All other things being equal, the gap to that target 10% would narrow considerably, as pointed out in paragraph 25. The fund currently uses 3 managers to manage our property assets: Colliers, LaSalle and DTZ. DTZ have recently taken over management of the active value products, so AV1 and AV2, given the old manager Aegon decided to exit the UK direct property market. That appointment of DTZ is fortunate for the fund, and its aim to simplify the fund's manager roster. Will end up effectively in a place where we have DTZ managing all our direct property assets and LaSalle managing all our indirect property assets. So a fairly neat split, indirect and direct. 29 describes how the fund will move from our current setup, using our 4 managers, if you like, to our 2 managers setup. Won't dwell on that table, it's fairly self-explanatory. 31 onwards is a view on what our property managers think the future looks like. I won't read through all of those there. I think that the neat table to look at is at point 33. So DTZ believe the UK property market should see the largest total returns within supermarkets, retail parks and industrials over the next 5 years. Not surprisingly, the lowest 5-year returns are expected from offices in general. If you see the graph at the top of page 59, you can see offices on the far right, you can see the supermarkets and retail parks on the left. 34 to 37 talks to our fund's actual property performance. We've got a table at 37, which shows the combined holdings returns over 1, 3, 5 and since inception. Largely in line with the benchmark, you know, a torrid last 1 year, but over the longer term in line with the benchmark. We've got some additional information if you want to read into the actual performance by mandates. We've got a section on the Colliers UK portfolio, a section on the LaSalle indirect portfolio. And the bit I will touch on is the DTZ active value 1 and 2 portfolios, which are closed-ended products, so they were due to return money around this time. DTZ have asked for extensions on those 2 funds, so to continue running those funds for a couple more years whilst the property market is in a better place, so not to avoid a fire sale of assets and accept lower property prices. So in the meantime, we will get rental income circa 5% from both, but it just means they don't have to bring onto the market 48 properties, which they may have to accept far lower returns on in the meantime. I don't have any other points to talk about on here unless there are questions.
Thank you, Will. Has anybody got any other questions? Mr. Denny.
Yeah, the RTZ fund that was a closed-ended fund, are you aware that all of the people invested in that are prepared to extend, or is it just a select few? I'm just worried about panic selling to favour other people.
So the view is that they've spoken to all the other investors. Weirdly, there is a fairly small collection of investors. We know some of the others as well, and they're of similar mind.
Unfortunately, Blaby, we're in a fund where people have been exiting and it's had to close, and we've taken a little bit of a hit. That's off the record, I suppose.
Thanks, Mr. Denny. Right, it's public now. Yeah. So if there are no other questions, the committee is asked to note this report. Is everybody happy to do that? Thank you. So we're now on to item 10, which is the risk management internal controls on pages 67 to 82 of the agenda pack. Declan, the Director of Corporate Resources, is granting this as a report. So over to you, Declan.
Thank you, Chair. I'll keep it brief, conscious of where we are with time. So the risks have obviously had a really good update this sort of time around, and I won't go through them in detail. Obviously, the members had some questions on Tuesday when we had that sort of training session, but happy to pick up any questions if there are any. The report also covers the internal audit section or just what they've covered. Obviously, the board look at this in a sort of a level more detail, both in terms of the planning of sort of the audit plan, but also kind of the reports that come back. Nothing of concern has been flagged up, but the committee does want any more detail in any of that. You know, they are obviously entitled to ask, but at the moment, the board does tend to get into the detail, that sort of thing. So happy to take any comments or questions.
So, has anybody got any comments or questions? Nick?
Two comments, Declan, which I think you're expecting, really. One is there's a mention in there about geopolitical risk, but specifically, of course, it is the issue about what happens about China invading Taiwan, because there have been a lot of saber rattling, dictators, sometimes actually from Hitler to Putin, and telegraph what they want to do, and people just sometimes just ignore them. But, you know, I think that's a very serious risk. And then the other one, which was almost picked up by LGPS Central as well, is the risk of, which some sort of commentators have made, is saying, well, let's have a sovereign wealth fund for the UK and take over the assets of the LGPS and give a government promise instead. I'd rather have real assets backing my pension than a government promise. I think the LGPS has actually been a success nationally. Or a watered down version is the government tells us what we should invest in rather than us deciding ourselves overall as to what it should be. Don't see that risk in the risk register.
So the first, I suppose, to tick off the first one, you're right, that sort of whole geopolitical one's, it's horrendously difficult, but I suppose part of that is, I suppose, the investment managers and their sort of view of where different risks like kind of land, but it is one that we'll kind of keep monitoring, and one of it is a little bit behind the decision the fund made at the last investment subcommittee to come out of some of the emerging market kind of sectors. So we're a bit more there's more freedom for managers now to move across the globe as opposed to actually having to be involved in the emerging markets, which is obviously kind of a difficulty when China's sort of by far the biggest constituent. So hopefully that'll help to mitigate that. But you are right, it's one of those that it's always hovering there, it's always been hovering there, but it does feel more prone to kind of sort of erupt as maybe it did, say, maybe a decade ago. The second one's a difficult one because if you took it at the extreme, in some ways it's easy because for the fund perspective, if you know the fund got nationalised, for example, actually we don't have to worry anymore because the government's backing it like it would the teacher's pension or the civil service pension. The difficulty becomes, which you've alluded to and Central touched on, is that where government get in between and they just start tinkering with things instead of taking necessarily the ownership of the impact that they do. So again, it's probably true to say that government's always had a little bit of an inclination to kind of do this. A few years ago, they tried to give direction about what we should or shouldn't do, and they always struggle. They've got to primary legislation, but it's also not lost on them that suddenly they've got to take sort of the consequences of their actions. So I think that's a real case of watch and see, because I think it is still a relatively low risk that government would do something that would really kind of make a dog's dinner of what we do here. I think their biggest kind of target is probably the private sector funds that have kind of closed and retracted into bonds and gilts, which is kind of obviously non-productive for the company, and also the defined contribution schemes, which kind of individuals kind of maybe can't access the infrastructure assets that we can and find a way of those, because in some ways they're the main ones that are guilty of kind of disinvesting as opposed to LGPS that's continued to invest. So I think it's a bit of a case of wait and see. We'll have a look at whether we should put it on the risk register. It's a difficult one because governments always make a lot of noise and then ultimately they kind of tend to back away a little bit from it. But yeah, we'll have a think about whether we put that on the register.
Okay.
Just let's say I think it should be on the risk register. I think it's a real risk within that, and I don't agree that we would have nothing to worry about if the government nationalises it. I agree it's a low risk. I'd much rather have my assets backed by real assets behind that. So I don't think that's a nil risk. You know, the issue I have in terms of our sort of fiduciary duty is the pensions promised are the pensions paid. That's how I define it. And having real assets has a much greater chance of that happening, in my view. But I take your point about, you know, it's probably not directed at us, but I still think it needs to be on the agenda.
No, look, it wasn't just one point. The point I was making is kind of the fund had ceased to exist if they nationalised it. So you may have a load of stress in your life, but actually our world's just got a little bit easier. So.
Okay, Zubair.
Thanks, Chair. I was just thinking, based on the conversations we're having around ESG, and wondering whether there's something about aligning our risk register with everything else we're talking about specifically around ESG. It's good to see there's a new risk which is logged in terms of risk to fund assets and liabilities arising from climate change. So if they're very specific, I suppose, if I can put it loosely, linking to the E of the ESG, do we need to have that maybe just, I don't know whether we feel there should be something more for the ESG as a whole. Because then I think I'm just trying to see if we talk about it at the committee level with all our fund managers, is it reflected appropriately within our risk register, or could it be a bit more specific?
Yeah. I mean, I suppose fundamentally the reason we, I suppose, do ESG or responsible investing is to make sure they kind of manage their focus on securing the kind of the medium long-term return as opposed to sort of short-term gain. So it's kind of partly covered in the register under that sort of, is the fund going to get sufficient returns? But we can clarify the wording on that, and I suppose it's in ways to Nick wants to just make it clearer of those sort of specific points.
Thank you, Zoe. I think after the last presentation, it's quite clear that this is going to be ESG is going to continue to be a massive focus, and we mustn't lose sight of other factors as well. So, have we got any other questions? No, we haven't. So the committee is asked to note this report and approve the revised pension fund risk register. Is that agreed? Yep, that's agreed. Thank you. So the next, okay, thank you, Mr. Day. Thanks for your contribution. The next item is the actions agreed by the investment subcommittee on pages 103 to 110. Normally this is taken as read, but there was substantial activity on the investment subcommittee. So over to you, Bhulesh, to present the report.
Thank you, Chair. I'll rattle through because I'm aware we're nearly there and we've still got another one to go. So this report talks about how we move towards the 2023 strategic asset allocation, mainly the changes that were enacted at the April investment subcommittee. The three shaded areas at table 3 are the changes that were enacted. So we've got listed equity changes at point 14, targeted return changes at point 23, and infrastructure changes at point 24. So I'll go to point 14 first. They're the changes to the listed equity portfolio, taking us down from 42.5, hopefully down to 37.5. There will be cash thrown off as a result, which is part of the reason why we won't do it straight away. We don't have the requirement for that much cash at the minute, so we'll time it accordingly with the private markets calls as they come through the year. A quick summary of the changes that were approved are at 14C. So they're the legal and general changes. Effectively, they're to simplify and to add a passive low carbon product there at C3. So 3.5% of total fund assets will go into the legal and general low carbon transition fund. Alongside that, we've got some changes at central. So we're decreasing the allocation to the central climate fund down to 12%. It's still a fairly large allocation, but there's no need to hold on to too much given we have alternative options such as the legal and general fund as well. We are increasing our allocation to the central global equity fund to 12%, and we are divesting from the central emerging market multi-manager fund. That moves us to neutral weight to emerging markets. Doesn't affect the fund's overall returns expectations. Targeted returns at point 23. You can see points A, B, and C there. We're moving to 2 managers from the 3 we currently have. We've got Aspect, Pictet, and Ruffer at the minute. We will end up with Ruffer and a new manager, Fulcrum. That will look after 5% of total fund assets. Again, we'll time the changes so that we are not left holding loads of cash, so we're looking back end of this year at probably the earliest. There was a requirement to move 2% to Fulcrum, pending negotiation of fees, which is now completed, so we can move on to completing subscription documents. Infrastructure at point 24, we moved up to a 12.5% allocation from 9.75. The underweight was circa 130 million. We concluded with Hyman's help at the time that 100 million commitment at this time would substantially close that weight. And if we needed to make a further commitment later in the financial year, we would do that. So at point 26, you can see the changes, a 35 million commitment to a central product. That's the core plus infrastructure fund, bringing the total commitment to 135. A $24 million commitment to the JP Morgan IIF fund, which we already have. I believe that's going to be called in July, so that will get out and start earning. And then a top-up 54 million commitment to the Quinbrook Net Zero Power Fund, which was somebody we invested to for the first time in July 2022. They were some of the changes.
Thanks very much, Bullish. Has anybody got any questions? Mr. Grimley.
Just on 23C, the fees to Fulcrum, we were negotiating. Did we get any movement there? Was that or did this stick to the, or did have to stick to their guns? Or
I think these things are commercially sensitive, but we did conclude negotiations at a more favourable rate. Yeah.
Thank you, Bullish. Any other questions? No. Right. So. We were asked to note the report. Is that agreed? Yeah. Okay. Thank you. So the next item is item 13, which we have is investment subcommittee membership. I don't intend to say a lot about this. The makeup of the committee is as indicated on the report. The dates of the investment subcommittee are noted. There is little else to say. It's for information. Can I take it that we agree to note this report? Thank you. So item 14, we now come to the responsible investment update. Again, this is on pages 113 to 166. We've spoken a lot about responsible investment today. Kat Chewy, the responsible investment analyst, will present the report. So over to you. Thank you, Kat.
So I won't keep you long, given how much Central spent on it, but just to highlight, I guess, the key areas of the report. So we have the update of the Responsible Investment Plan that members agreed in January, and also so progress against that, and then also what you've got to look forward to on top of Central's ESG tool, and also the next iteration of the climate risk reports. Just to highlight some of that RI had their LGPS Central had their RI Summit, which hopefully members found useful, and they also circulated videos if you weren't able to attend. We've also in the report got our latest Task Force for Climate Related Financial Disclosure report. So this is our third iteration, and I think members probably remember that this isn't something that we're required to report on at this moment. So we're following the occupational pension scheme kind of regulations in terms of what we report on, and government had consulted last year on making this a requirement for LGPS funds. So we're ahead of the curve in that respect, but I think we need to wait to see what governments say and what comes out of the recent consultation to see how we can improve that. But this iteration is kind of based on best practice in terms of what occupational schemes are reporting on. So it is a improvement on what we've previously reported, and kind of sets out the really good work that the committee has undertaken in the past year. The only other part is the update on the Court Fund's quarterly voting report, and also stewardship report. So they're the normal quarterly reports we get from LGPS Central, LGIM, and the Local Authority Pension Fund Forum. And that's all I was really going to highlight. There's also a kind of section at the end which talks about governments powering up Britain proposals, which kind of feeds into the discussion we've had about where government are maybe looking at influencing pension funds, and how we kind of just wanting to be aware of that in future. But that's all I was going to say on the reports.
Thank you very much, Kat. Has anybody got any questions or queries on the report? No? Okay, so once again, the committee is asked to note this report. Can I take it as noted? Yep. Thank you. The next item is the date of future meetings. These are scheduled all to take place at 9:30. The list of the dates is there. Members are also asked to note the Fund's annual general meeting, which will take place at 12 noon on the following date, which will be open to all scheme members to attend. 11th of December 23 and 9th of December 24. Both of these seem a long way away. Could I ask members to agree the dates? Is everybody in agreement? Thank you. The next item is any items the chair has decided to take as urgent. There are no urgent items. We're now going to go into private session. I move that in accordance with the Local Government Act 72, the public is excluded from the meeting for the remaining items of business on the ground that they involve the likely disclosure of exempt information. Is everybody happy to do that? Thank you. So we'll just wait for us to come offline.